Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Pewet Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're focusing on Pewet Technologies today.
Right.
This company is trying to position itself right at the epicenter of this whole AI infrastructure boom.
Specifically where those data bottlenecks happen in the interconnects.
Exactly. They're what we'd call a critical AI photonics enabler.
An enabler. That's a powerful term. And we keep hearing about their proprietary optical interposer platform.
We do.
So is this just, really good marketing? Or does this tech genuinely give them some kind of sustainable, defensible moat, especially in a sector with giants like Broadcom and Intel?
It's absolutely the core technology. And if they can execute, it is their moat. To really get it, you have to understand the old way of doing things. Traditionally, you take your electronic chips and your optical chips.
The parts that send and receive the light.
Right. And you'd mount them separately. It required all this complex manual alignment with fiber optics and tiny fiddly parts.
So, like performing a delicate surgery just thousands and thousands of times over?
Precisely. The optical interposer platform it changes the whole manufacturing paradigm. It's a revolutionary kind of passive foundation.
And that allows for this, what's the term? Heterogeneous integration.
Heterogeneous integration of photonics and electronics, yes. And critically directly at the wafer scale.
Okay, let's unpack that for everyone listening. What does heterogeneous integration at wafer scale actually mean for a massive AI data center operator?
It means you're replacing those thousands of manual steps with a simple automated chip-level process.
And that's where the savings come in.
That's where the physics and the cost savings meet, because they get rid of the need for those bulky traditional components and just simplify the assembly so drastically. The advantage is overwhelming efficiency.
Efficiency and manufacturing cost is one thing, but the power savings are what really jumped out at me. We're talking about a massive reduction, right?
That is the killer metric in AI infrastructure today. I mean, the optical interposer platform can reduce power consumption by up to 80% for these interconnects.
80%.
Compared to the traditional pluggable modules, yes.
That is not a marginal gain. I mean, when you think about these hyperscalers running AI clusters that eat up megawatts of energy, 80% is billions of dollars in operational savings.
It's savings. It's massive heat reduction, and, it means higher chip density in the racks. It basically dictates how well you can scale.
It fundamentally changes the unit economics of AI networking.
It does.
And we've seen some third-party validation here. I noticed that a PO8 customer, Celestial AI, was just acquired by Marvell.
Right, one of the chip infrastructure giants.
So my skeptical question is this. Is that really a validation of Pewet's hardware? Or did Marvell buy them for their software or some other IP? How do we know the interposer was the key?
I think it's strong validation because of the context. Celestial AI was all about advanced, highly integrated optical interconnects.
Yeah, okay.
And Marvell needs those ultra-low power, high-density optical solutions to compete. Their acquisition signals an urgent need for exactly what Pewet is selling. The whole strategy would have failed if the underlying platform wasn't robust and scalable.
So the tech thesis seems validated, and the macro trend is, well, it's unmistakable. Let's pivot then. Because revolutionary tech only matters if it becomes a viable business.
And this is where the picture gets complicated, but also incredibly exciting.
We have to talk about the financial inflection point.
It's a classic high-growth, high-risk story playing out in real time. If you just look at the Q3 2025 revenue figures, they reported a truly massive 7,998.6% year-over-year increase.
Nearly 8,000% growth. That's hypergrowth.
It is. And it signals that demand for their optical engines in AI data servers is really starting to accelerate.
But those percentages, we have to put them in context. That growth is coming off a very, very small base. It has to be sustainable. Where is this revenue explosion actually coming from?
It's tied directly to their first real steps toward mass commercialization. This isn't just engineering revenue anymore. It's driven by early production orders.
Including a pretty significant one, right?
A very significant $5 million production order for 800G optical engines. This is the transition.
And that manufacturing momentum, it's backed up by their current order book,
Correct. The company's holding a total order backlog of $5.6 million, specifically for their high-speed 800G Infinity modules.
which gives a clear, visible path for revenue over the next few quarters.
Conditional, of course, on them actually executing that manufacturing ramp-up.
That visibility is reassuring, but we can't ignore the other side of the ledger. Despite that near 8,000% growth, they still missed the Q3 revenue consensus.
They did. Came in at 0.3 million versus 0.55 million expected.
And more critically, the negative net margins are, well, they're alarming. Negative 6,625%. And a trailing 12-month net loss of over $50 million. How do we reconcile those huge losses with any kind of bullish thesis?
That massive loss is the necessary trade-off right now. It's actually typical for companies in this exact phase. The $50 million loss isn't from poor sales.
It's from investment.
It's a direct consequence of their strategic investment. They're pouring money into R&D and building out new manufacturing lines to scale up and meet the demand they see coming.
So the argument is they're spending heavily today to build the capacity for future high-margin production. They're banking on unit costs dropping dramatically once they hit volume.
Exactly. It's a cash burn situation, but it's focused squarely on future dominance. The negative margins are the cost of building that moat.
Which brings up the critical question, how long can they sustain that burn? Let's talk financial health, because managing that runway is everything.
And their balance sheet is surprisingly robust, which is what elevates this from just another speculative tech play. Crucially, the company operates with zero debt.
Zero debt. That gives management maximum flexibility, especially during a capital-intensive ramp-up.
Absolutely. But the real cushion is the cash position they've built up.
Through those equity raises.
Exactly. They secured $250 million in gross proceeds from financings in 2025. That includes a major and very validating $75 million raise in October from a single institutional investor.
That kind of commitment from one big player, that signals some deep confidence in their plan.
It does. And that $250 million is specifically for funding their AI growth strategy.
And if you connect that huge cash reserve to their quarterly burn, which is about $2.8 million from operations, that gives them a phenomenal runway. It mitigates short-term dilution risk.
That's the key takeaway. This isn't just safety money, it's scaling money. They're deploying it to accelerate the manufacturing ramp-up plans, specifically at their facilities in Malaysia.
And they're partnering with specialists like Globetronics to do it.
Right. The goal is to rapidly scale capacity. The operational target is to be able to produce over 1 million optical engines a year.
1 million units. If they can hit that volume and if their promised unit economics hold up, the whole profitability picture just flips instantly.
The 1 million unit target is the hinge point. That kind of volume would let them spread those massive upfront R&D costs across a huge number of units.
And turn those painful negative margins into potentially very strong gross margins.
Everything hinges on successful execution in Malaysia.
Okay, so let's shift to how the market is responding to this complex picture. The stock itself has seen a lot of volatility, but it seems like there's been a recent shift in sentiment.
There has. The stock has shown strong bullish momentum lately. For instance, we saw a noticeable 14.9% surge after a key investment bank raised their price target.
From $7 to $8.
Which analysts see as institutional confirmation of the growth story.
And what about the technicals? Is this just a short-term pop, or is the foundation looking more solid?
The technical indicators look pretty constructive. The shares are trading above both their 50-day and 200-day moving averages.
Which analysts often interpret as a solid accumulation phase, suggests the long-term trend has turned up, and institutional money might be building positions.
That's the read. And beyond the moving averages, if you look at market flow,
The options activity and short interest.
we're seeing elevated call option activity. That's bullish speculation. And crucially, short interest has been declining.
So fewer people are betting against the stock.
Right. And that combination is what we call a bullish divergence. Shorts are covering, and new money is betting on the upside. There also seems to be technical support near $6.50, which traders might see as a potential entry point.
So moving forward, what are the events that could prove this thesis right in the near term? What should people be watching for over the next, say, 3 months?
The most immediate and critical catalyst is the Q4 2025 earnings report. We're expecting that at around March 2026.
And the market's focus will be laser sharp on one thing. Execution.
100%. Management has to show they're successfully fulfilling that $5.6 million backlog and show a real revenue inflection.
And beyond the immediate revenue, they have to show the product roadmap is future-proofed, right? As the industry moves past 800G.
Exactly. They're not standing still. The partnership with Semtech to develop 1.6T receivers, which are sampling now, is key. It shows they're already preparing for the next data speed doubling.
And they're also working on components for the long-term future, which is co-packaged optics or CPO.
The CPO is the final destination for hyperscale AI, putting the optics right on the same package as the chip. And POT's development of the POIT Blazar external light source is a key step there.
So the product pipeline seems perfectly aligned with this huge macro tailwind. The surge in AI data center capital spending just keeps going.
The AI arms race is their primary strategic driver. As long as big tech is pouring billions into training and inference, the demand for faster, smaller, more power-efficient optical engines is a non-negotiable requirement.
All right, let's be responsible and look at the risks. The bull case is compelling, but where are the biggest pitfalls? What's the bear case here?
The bear case really centers on three areas: execution, competition, and valuation.
Let's start with execution.
Risk number one is scaling that Malaysia manufacturing operation. The transition from R&D to high-volume commercial production. It's a graveyard for a lot of tech companies. Any delays there could really exacerbate their unprofitability.
And risk number two comes from how they got all that cash. We're talking about dilution.
Absolutely. The recent sale of nearly 30 million shares is a significant increase in the share count, and that puts downward pressure on earnings per share for existing holders.
And then competition. Intel and Broadcom aren't just sitting on their hands.
Not at all. They have vastly superior manufacturing scale, global reach, deep relationships. If a major competitor introduced a competitive solution, even a slightly less efficient one, their ability to execute at scale could quickly undermine POET's opportunity.
So if we put this all together, the revolutionary tech, validated demand, a huge cash cushion, but also this daunting execution risk. What's the final analysis?
POET Technologies presents a definitive high-risk, high-reward proposition. The risk is the manufacturing challenge and the near-term losses. The reward is that proprietary technology moat in an exploding market.
So the fundamental pieces for success are there. They have the cash to survive the ramp. They have the confirmed backlog. It all just hinges on whether they can execute that scale up in Malaysia over the next year.
It's a phenomenal setup to watch unfold. The macro tailwinds are so strong that if they hit that million-unit capacity goal, the potential payoff is significant. But the final thought I'll leave you with is this. In the race for AI supremacy, the bottleneck always shifts. If POET solves the interconnect problem, which new hardware limitation will define the next generation of computing? And are they already positioned to solve that one too?
The fascinating question to end on. If you want more cutting-edge analysis like this, be sure to hit that subscribe button to Smart Wealth with Joshua.